Seems like Stephanie's chatty today, so we'll just let her go for it.
Hey guys, welcome to another Monday morning market update with Stephanie, John, and Rosella. See, I mixed it up there. See, I got all three of us into that particular little introduction. How about that? All right, we were talking earlier. You guys had some questions about some investment property loans. Let's chat about that a little bit now here.
So I guess, have a few questions about loans structures for somebody who purchased an investment property that maybe may be eligible, I guess, for refinance on the investment property, especially if it's now starting to create income for them. And we had somebody else that was here local that basically said that they have some loan options for those self-employed borrowers that have investments. But I'm curious to know, what does that look like, and what kind of value needs to be there, I guess, for someone to utilize that opportunity to potentially refinance or even purchase?
Okay, got it. We have a webinar, and we'll put a link for it onto it in this video that is entitled, I believe, 7 different ways to qualify for a home if you're self-employed. And that covers a lot of the bases here that we're going to chat about. There are a lot of options if you're self-employed. And clearly the one that most people think of naturally is to give us tax returns and all of that. When you're self-employed, we use 2 years worth typically. You can do 1 year's worth depending on the situation and the amount of self-employment, the length of time, and all of that, and qualify with tax returns and then use the income on the property. That's the normal. And if you were to purchase a single family residence, you're going to be putting 20 to 25% down. You're going to find out the rate is significantly better when you put a little bit more down, like 25% over 20%. But you can buy a property with that. And the refinance for cash out, to speak to that, Stephanie, you're typically in the neighborhood of 75% of the value of the property. There are some seasoning issues there, especially if you're going to pull cash out. You need to own the property for a year for Fannie Mae if you want to pull cash out when you do a refinance. But if you're going to do what's called rate and term, which means just pay off the underlying mortgage, and usually you do that because you get a better rate and the payment lowers, then the seasoning is less. And we do have loans available that have no seasoning at all. You can actually literally purchase a property. Let's say it's a rehab and you're using what we call hard money. That's private money that we have through our company to help somebody buy a property and rehab it. And it takes them 3 months and they're done. And then they want to refinance, but the value has increased substantially. Fannie Mae is going to have a little problem with that if you want to pull cash out. We do have loans that will do that immediately without seasoning, based on the value, the appraised value, and go up to as high as 75% typically of the value and pull cash out. Which leads us over to what we're chatting about initially on the call, before the call, was the DSCR loan, which stands for Debt Service Coverage Ratio loan. And that is a loan that investors can use, self-employed people can use to buy or refinance a property. We're using just the income on the property as the qualifying income. So if your tax returns don't work, there's not enough income there, we don't use those. We'll use the income on the property. We'll get the market rent. And by the way, if it's a short-term rental, we can have the appraiser give us what the short-term rental income is and use that as well, which oftentimes is significantly higher than a long-term market rent. One or the other we're going to use. We want the rent payment, short-term or long-term, whichever way we do it, to be equal to or greater than the mortgage payment. So in other words, the property income is enough to pay the mortgage. And there's a 1-to-1 ratio there. You can go below that. So if the mortgage payment is somewhat higher than the rental income, we can do that as well. But the parameters change. The loan to value drops a little bit usually, and the rate isn't higher because it's a little more risky for the investor. So that's kind of a lot in a fire hose approach there, you know. Go ahead.
But I want to, I guess, ask. So essentially, you're telling me that someone, say like Rosella or I, who are self-employed, could come to you and say, "Hey, I found this really great investment property. I think that the rent would more than cover, what my potential mortgage is. I can go and potentially make a loan application and purchase that without even providing tax returns or income verification, just only off the property alone."
That is exactly right. As a matter of fact, I did a presentation recently to a group of investors, and I showed them the loan application with the income portion of it filled out for a regular loan. And there's all that documentation we get from you, 2 years of self-employment. And this person I said had a change in jobs, so they had to go back and get the previous employment and all of that, as opposed to exactly what you're alluding to, Stephanie. The loan application for the DSCR loan is blank where there's income, because the only income we use is the income on the property. Even if you have multiple properties, we don't get the rental income on the other properties because it's not relevant to that particular loan. We use just the income on the subject property.
How
So on a
much would
purchase,
you down?
pardon me?
How much would somebody typically need for a down payment?
That's just what I was going to next. That's right. A purchase is different than a refinance. The smallest amount down currently that we have for the DSCR loan for the purchase is 15%. So you can do an
Okay.
85% loan, but it gets much more difficult to qualify because the lender currently, and guidelines change, guys, so you should call if you have a situation because they change frequently. Currently, we need a debt service coverage of 1.25. That means that the mortgage needs to be 25% greater than the other way around. The rental income needs to be 25% greater than the mortgage payment if you're putting 15% down. If you put 20% down, then it's 1-to-1. You just need them, the mortgage needs to be equal to or a little bit less than the rental income, and you're good. And if it's less than that, you can put 25% down and we'll go down to 75% of the rental income. So
Why is this type of loan not used more often or known about?
In the circles that I talk to, it's used a lot. We do a lot of this particular loan. That there are 3 investor loans that we do a lot of loans. One is the investor that has tax returns and lots of assets and so on. But there are a lot of limitations there, including the number of properties you own. So when you get 10 properties, Fannie Mae is typically not going to do you anymore, any loans for it. They're going to say, sorry, you have enough. We have unlimited properties with the other 2. The other 2 are the debt service coverage ratio loan, because it's so simple, and as long as there's enough income on the property, you qualify, and bank statements. So if you're a self-employed borrower and you don't have tax returns that show income, but you roll a lot of money through either your business or your personal, one or the other, we'll get 12 months worth of bank statements, average that income out with qualifying deposits. I don't want to oversimplify this. We won't use all deposits. It needs to be income, and we'll use that for qualifying income for a property. And we do a lot of those. There's a lot of borrowers that come to us specifically for those kinds of loans.
2 follow-up questions. One is, it has to be an investment property. I'm assuming it cannot be owner occupied for this type of a purchase.
For the DSCR loan, it does have to be investment because we use income. For the bank statement loan, it can be investment or owner occupied because we're using bank statements.
Okay. Secondly, in comparison to traditional financed rates, are we talking a big difference in rate?
It's based on 3 things, okay? Loan to value is a biggie, and credit score. So those 2 are probably going to drive it, but loan size as well. So loan size, loan to value, which means the loan amount divided by the property is loan to value, and your credit score. With a really good credit score and 75% loan to value, apples and apples to a Fannie Mae kind of loan, the rate is probably going to be 1%-ish, 1.5%-ish higher than a Fannie Mae loan. But we do interest-only payments on this. So when you put an interest-only payment in place of an amortized payment, the payment is about the same and sometimes less. And then one last thing, if you put a large down, like 50% down, and you have a good credit score, the rate's almost comparable with Fannie Mae because the rate drops on these loans with a lower loan to value. The lender looks at it as a less risky loan, so the rate's better.
Okay. I think you just gave
Very
me some ideas.
Yeah.
Thanks.
What
Well,
an email can do, yeah.
I'll give you one more idea that when I do this presentation to the investor groups I talk to, the business opportunity here is this. If you don't have any income, but you have access to cash, there's a seasoning issue on where the down payment's going to come from. So that's a biggie. Okay, we got to get that out of the road, and you need to have good credit. If you have good credit and you have access to cash, and we can solve that seasoning issue, which we can talk about, you can potentially purchase a home with a hard money loan. That's the business plan here. We don't care where the down payment comes from on a hard money loan. So you buy the home, it's a dump, you fix it up with a hard money loan, takes you 3 months, 6 months, whatever. You can either sell it when you're done, or with our lender that has no seasoning issue there, you can refinance that home with a DSCR loan and potentially pull cash out and go ahead and do another one.
Okay.
It's a great way to do it. The costs are higher. I mean, you just got to know that going in. If you don't have a job and if you're self-employed, you can't show income, the costs are going to be higher. You might have to do a hard money loan, which costs money, but you don't do it unless you're going to make money on the house, right? And then the refinance loan, if you keep it, is going to typically be more expensive than Fannie, but not so much so that people don't do them. We do a lot of these loans.
I was gonna say, I mean, the cost of doing business in a way of like this, I mean, oftentimes people are willing to pay a little bit more just for that complete
For that
ease
simplicity.
and convenience. Yeah.
Yeah.
So
I had a borrower this month, as a matter of fact, not too long ago, that applied for a loan, and the loan to value on the property was really low, but he didn't want to go through the hassle. So and he knows me really well. He said, John, can you give me some hard money? Oh yeah, no problem. I know, no problem, Andy. We can do that. I talked to my hard money lender, and he goes, why isn't he getting a regular loan? And it's just exactly what you just said, because it's easy to do these loans. They're simple, they're quick, and they're easy. And people oftentimes pay more for that privilege.
yeah, for sure. I could see why.
Yeah.
What's the definition of a good credit score, I guess, like, and I do it that way because we know that there's variance.
There's a broad spectrum
Yeah.
of what we're considering good these days. And it's
Good
applicable to
questions. Good questions. It's tiered. It's usually every 20 points difference in your credit score. So these loans can be done with a credit score potentially as low as 620. 640, you're going to get a better rate. 660, you get a better rate. 680, it'll be a little bit noticeably better. Over 700, noticeably better. And when you have a credit score of 740 or greater, maybe 760, 780, you're going to get the best rate there.
Okay.
Anything higher than that's about the same.
Okay. Good to know. I have a few of these. I might make a few phone calls to actually. Hey, did you know about this? Let's go and do these.
Yeah.
Because as we discussed, this is a really good rental market still, where oftentimes your rent that you can generate off of properties is still far greater than what your mortgage payment could be. And that even goes for new construction still. Like
Exactly.
that's a really good sweet spot for people to start acquiring investment properties, is go find those new constructions that they're offering those large incentives, get your mortgage payment to a sweet spot and turn right around and rent it out.
Yeah, we will typically allow the seller to pay, if it's a non-owner occupied, up to 4% of the purchase price to buy down the rate with these particular kinds of loans. The rate can be bought down just like any other kind of loan. They have prepayment penalty. I should not forget to mention that. You can do 0 prepayment penalty if you choose to do so, or 1 year, 2 year, 3, or up to 5 years. The rate is lower with the longer prepayment penalty option. And most of the time, my borrowers get at least 1 year because they know they're not going to do anything for a year, and maybe 2. And so we'll show you those options, whichever one makes most sense for you, we can do.
Okay.
Great question.
All right, any more questions, ladies?
No, that was super informative. Thank you for giving us those clarifying factors. I appreciate it.
Yeah, those are fun loans. We like doing those kinds of loans. They're borrowers who really appreciate it. They get it. They're not rate-driven borrowers. They're profit-motivated, cash flow kind of borrowers, and they're great to work with. They really get it.
Thank you.
Thank you. Good to chat with you, ladies, once again. Appreciate the Monday morning updates from you. Appreciate chatting with you about loans as well. Oh, there's Jade. Bye, Jade.
Thank you. And make sure and give us the link too, so we can send out that webinar invite to some of our investor clients.
Will do. All right. Thanks, ladies.
Thanks, John. Have a good day.